Crypto can be really polarizing. On one extreme, you've got the diehard fans who absolutely love it and it's 100% of their portfolio. And on the other end, you've got people who hate it and they just prefer their traditional investments that they used to. But wherever you sit, I think it's important to discuss whether you should be considering it for your portfolio, whether now is the right time to invest, and most importantly, when might be the right time to sell. I say most importantly because the exit is harder than the entry. There's the risk of round tripping. This is where you invest at one point, you come into profit, you think it's going to continue, only for it to come all the way back down, and you end up selling more or less similar to what you bought it at. I know it sounds simple, but any unrealized profit is unrealized until you come to sell it. And I think it's very easy to look back and think, oh, well, if I've just bought it here, I would have just held it. And if I sold now, I would have been up. But you forget about the volatility that comes in between and that emotional roller coaster that you have to go on just to be able to buy at one point, ride it out, and then pick your selling point. Time horizon with the crypto markets is so important. And this is where we have to put some context on it. Let's use Bitcoin as an example. If you invested in Bitcoin at any point in its history, apart from the past 4 months, you would be in profit right now. So whether you invested 10 years ago or 6 months ago, you'd be in profit right now. And it could be substantial profits at that. The problem is that we have this short-term view because we see things like meme coins and all sorts of other cryptocurrencies that balloon overnight. And we feel that we need to be in and out really, really quick. And when we actually think about it, we don't want to wait 2 years to get a return on our investments because we're seeing these young guys that are becoming millionaires overnight just from investing in some random meme coin that has absolutely no value, but we're seeing these massive returns, and that makes us view this as a short-term investment. Bitcoin is also not being used as it was intended to. If we think about what Bitcoin's purported benefits are, it's always compared to gold. It's that store of value. It has a limited supply. It's easy and cheap to hold, and you can transfer assets very, very easily. In times of uncertainty, we see things like gold increasing in value. We've seen that in the past few weeks where gold has hit all-time highs, yet Bitcoin has fallen from its recent highs. The problem is, and what makes it so volatile, is that people are not using it as a store of value. If that was the case, people would just be holding it long-term, just like they do with gold. The problem is that people want to make more money out of it, so they trade it. If you look at the volumes on a daily basis, that's not your long-term holders. Yeah, of course, there's going to be people who have sat there for years and years and have not touched it. If you look at what's happening on a day-to-day basis, it's people wanting to day trade it. They're treating it just like the Forex markets. I do think it will eventually get there. The volatility will die down and people will start to see it as a long-term store of value. But in the grand scheme, you've got to think it's still in its infancy. It was only created about 15 years ago. Bitcoin is so different to any other asset out there, specifically down to its limited supply and its halving cycles. So Bitcoin has a fixed supply of 21 million coins. It also has a 4-year halving cycle, which you may have heard of. And every 4 years, its supply gets cut in half. And that's what gives it the cyclical feel. So we look back at history and we look back at the previous cycles. In 2012, 2016, 2020 and 2024, there was a halving event. What followed from that is an all-time high. So in 2013, it hit an all-time high of around $1,200. It then crashed all the way back down to around $160. Then in 2017, after the next halving event, hit an all-time high of just under $20,000. Again, the following year, it then crashed all the way back down to around $3,000. Then in 2021, it hit an all-time high of around $69,000. Again, the following year, it then came all the way back down to around $15,000. And then at the time of recording, is currently sitting around $90,000, having hit an all-time high of around $108,000. The reason I wanted to go through the cycles like that is because it brings around the point of it's now 2025 and that's when we're expecting the next all-time high. Of course, if it follows the previous cycles. There are some people that think these cycles will slowly diminish, and as its popularity and its market cap ever increases, it will eventually smooth out and it will generally just be a little bit more just like gold. It will gradually increase over time. So you first off have to decide whether you think these cycles are going to continue in terms of this year, maybe into the next 4 years as well, or do you think it's going to be a little bit smoother now? If you think the cycle is going to repeat just like it has done the past 3 cycles, well, now your decision is, are you going to invest for the next 6 months? Because if we're expecting it to be an all-time high come the end of this year, and then we expect another crash again, are you willing to ride that out? If you are, then great, have a long-term approach, right? Because if you're thinking, I'm happy to sit on this for 5-10 years, it doesn't really matter when you enter. And that's why I made the point about the exit is so much more important than the entry. Even if you invested at previous all-time highs, let's take 2017 as an example. So at the end of that year, Bitcoin hit just under $20,000. Now, if you invested at that time and then you watched your investment fall by 85%, you would have thought it's the worst thing ever. You may not even hold it. You would have sold it, right? However, that's just under 8 years ago. If you were to hold it from now, you would have 5x'd your money in just under 8 years. If you compare that to any other traditional investment, that would have been an amazing investment, right? So if you have that long-term view, just set it up automatically so you're investing regularly. It doesn't really matter about timing the market. You just want to get money into the market. Set it up so it goes in, whether it's monthly, even weekly, and then just set and forget it. Your time to sell and cash out your potential profit is going to be at least 5 years from now. So you don't have to think about it. Obviously, make sure it's money that you're not going to need in that period. Make sure you're comfortable with the percentage of your portfolio that you can commit to that you're not going to need in that time. If your view is that you don't want to ride out a 70% dip, if you believe that it's going to be an all-time high come the end of this year, well then that regular investing approach doesn't really work for you. You want to get your money in now, and the sooner you get it in, the better, because the later you leave it, if your view is that it's going to continue to increase towards the end of the year, then obviously you want to get in as soon as you can. You then want to think about your exit strategy. So just the same way that we can average into an asset, you want to think about how you can average out of an asset. You don't need to sell it all in one go. You could pick a time towards the end of the year, maybe over the last 3 months. Maybe it's every week, every couple of weeks. You take about 10% off the table. There's a saying that says, no one ever went broke taking profit. There's going to be a temptation, especially if it's rallying and it's increasing massively in value, that you don't want to take that profit because you want to keep it there. The risk is that we come back to the point I made earlier about round tripping. You wait too long, it starts to correct. You then think, oh, it's just going to be a dip. It carries on correcting, and then you're back in the same position or towards where you started. I focus on Bitcoin because it is the largest and it is very different to the others. The other big ones like Ethereum and Solana are potential ones that you could look at. They are quite different, but they at least do have some form of revenue stream. They're what we call a layer 1 cryptocurrency, i.e. they have their own blockchain. So if you're a cryptocurrency that you want to transact on a specific blockchain, and you do it on either the Ethereum or the Solana network, then they will pay network fees and transaction fees in that native cryptocurrency. But the further you move down the market cap of cryptocurrencies, the more risk you take on. Yes, the more potential you have, but you have to think about, where does that value come from? If you're just investing into a meme coin or the latest AI token, you have to think the only way that that goes up is through hype. What's going to make that continue to go up? You can almost see that as gambling. That is money that you're willing to lose because that literally can go to zero. So first decide of how much of a percentage of your portfolio do you want to commit to crypto. Then think about what percentage of that percentage do you want to then split between a few different ones. The main point is about being really clear on your time horizon. Are you willing to ride out the next few years? Ride out those massive dips? Are you going to panic? Imagine what you're going to feel like if it does come down 50%. Is your mindset going to be, oh, I can add more because it's now cheaper? Or are you going to be thinking, all right, this is it, it's over, I need to sell? Think about what your mindset's going to be at that time. If you've got that long-term approach, just invest, sit back, and try and ignore all the noise that's going to come up in the next few months and into the next few years. Remember, the people making loads of videos, writing loads of articles, are not trying to help you out. They're trying to get clicks. They're trying to get views. Think about why that content exists, why it does well, and what the actual agenda behind it is. That's why you have to really ignore the noise. Have your principles, know why you're doing something, and then stick with it. I hope that helps. Let me know your thoughts in the comments below. Subscribe if you're new, and I'll catch you in the next one.